Okay, so we're moving into chapter 3, one of my favorite chapters. It's cost, volume, profit. And what we're going to do in this chapter is take the information that we've already learned so far, and you'll have to remember what are fixed costs, what are variable costs, and work with that to look at what happens when you change one of the three, cost, volume, profit, the impact on the other two. And so I'm going to start with problem 325 in your book. And so another thing that kind of reminder for you when we're talking about income, we have sales and we'll start working, well, let me back up. We have sales, we have cost of goods sold, we have gross margin, operating expenses, and operating income. Okay, so this is our product cost. This is our period cost. This is our direct material, direct labor, manufacturing overhead. So that's a traditional. Also, I'm going to add something in here that you all know about, income tax. And once we take that off, we have net income. And the reason I'm putting this on here is because we're getting ready to move into some calculations where we'll be calculating operating income and net income. And so I wanted to remind you of what that skeleton income statement looks like. Okay, so in problem number 325, we have a company that manufactures and sells pens. Currently, 5 million units are sold per year at 50 cents per unit. I'm going to use Excel, and I'm going to try to set this up to use formulas because we're going to do a lot of what ifs, and if we use our formulas correctly, then it makes it a whole lot easier. So let's see what else. We've got fixed cost of $900,000 per year and variable cost are 30 cents per unit. Okay, so then it says, what is the current annual operating income? All right, so if I need to know what my operating income is, now this is a traditional income statement. A contribution margin income statement takes my sales minus my variable cost, gives me my contribution margin, then I subtract my fixed cost, and I get my operating income. This is used internally, and we may talk a little bit about that, but just this one really doesn't even have to follow either one. Basically, we just need to get sales minus cost and figure out what our income is. So our sales would be our number of units times our sales price per unit, and then our variable cost would be 30 cents for every unit, and then our fixed cost would be $900,000. So our operating income, and I can just do a sum here, is 3.1 million. That doesn't seem right. Hang on just a second. 5 million units sold. 20. Yeah, let me do this again. I don't know why. Oh, I know why. Sorry. I didn't know why that was showing up negative. It's because I hit the key. All right. Sales minus variable cost minus fixed cost. There we go. That looks right to me. So our operating income is $100,000. It asks us in B, what is the current break-even point in revenue? So break-even point, and hopefully you've read and you're familiar with this. If you think about it, break-even just simply means how many units do I have to sell to cover my variable cost and my fixed cost. So if you're selling something for $2 and the variable cost is $1, so every time you sell one of those units, you have $1 of contribution margin to cover your fixed cost. If your fixed cost is $10 and you sell 10 of them, you've covered your fixed cost, and that's break even. So the formula is your fixed cost divided by your contribution margin per unit. That gives you break even units. So for this particular problem, it would be our fixed cost divided by our contribution margin, which is our sales price per unit minus our variable cost per unit. And I don't want that $sign on there or those decimals, and the reason is because this is in units. If I'm dividing by the contribution margin per unit, then that's units. So if I wanted to check this, see here how we multiplied by A16? If I want to check this, if I change this to 4,500,000, my operating income should equal 0, and it does. So I broke even. So that's how I know that that's right. So you can do it either way, but it asks for break even in sales dollars, and so I'm going to take that number of units I need to sell to break even times my sales price per unit, and that is in dollars. And so I need to sell $2,250,000 worth of my product in order to break even. Okay, so then in the next part it says compute the new operating income for each of the following changes. And it says a 4-cent per unit increase in variable cost. Now, this is why I did it this way. So in theory, I should be able to come up here and change this to 34 cents, and that's my new operating income, negative 100,000. Now, if you're doing this for your homework, you can just, every time you change, you can copy this and paste it. Paste special, don't use the formulas, and number that as number 1, 2, 3, 4, 5. But in practice, if you're a manager and you're doing this, then you're just playing with the numbers. And there's a lot more we could do in Excel, but this isn't an Excel class. So then it says a 10% increase in fixed cost and a 10% increase in units sold. And I'm going to assume that these are not comprehensive changes. So a 10% increase in fixed cost. So this is going to go to 990,000. That's a 10% increase. And a 10% increase in units sold. So this is going to go to 5,500,000. It's a 10% increase. It says what happens to my operating income? It goes to 110,000. Okay, so I'm going to change these back. All right, and then in number 4, it says wait, am I on the right one? Yeah, in number 4, it says a 20% decrease in fixed cost. So 20% decrease, so 900,000 times 80%, 720,000. A 20% decrease in selling price, so 50 cents times 80%. Was it a 20? Yeah, 80%. Forgot my equal sign. All right, and then a 10% decrease in variable cost per unit. I think I can do that one in my head. And then it asks also a 40% increase in units sold. So I think that's 7 million. So now my operating income is 190,000. So you see why we use the cost volume profit in management. We're saying, okay, what if we did this? Well, what if we did that? Well, what if we did this? What if we spent less money on fixed cost and dropped our sales price? By doing that, you can see what's going to happen to your bottom dollar, your operating income. Then it asks us, and I'm going to go get rid of those changes I just made. Okay, back to where I was. And it says, compute the new break-even point in units for each of the following changes. A 10% increase in fixed cost. So I did my break-even down here, and I used my fixed cost from here. And so if I do a 10% increase in fixed cost, 990,000, my new break-even is 4,950,000 units. Okay. And then it asks me a 10% increase in selling price and a 20% increase in fixed cost. So my 10% increase in selling price would raise this to 55 cents. And my $20,000 increase in fixed cost would change this to 920,000. So my new break even is 3,680,000 units. So again, you can get this is an intro of cost volume profit using formulas in Excel. Learning how to play around with the numbers is from a management perspective. I'm currently working with on a consultation right now. And this is what we're doing for a bakery. We're doing a cost volume profit analysis to determine where they need to focus their efforts in their bakery. And so it's very applicable to real life, not necessarily even accounting, but more of a management perspective.